You've been told stock market crashes are modern accidents, a side effect of technology, computers, algorithms, greed gone wild. That's comforting, because it suggests we could fix it. But what if I told you the first stock market crash happened 2,000 years ago? No screens, no apps, no Wall Street, just Rome. And the same human instincts that still move markets today. Rome didn't invent stocks, but Rome invented speculation. And once speculation exists, crashes become inevitable. Let's rewind. Ancient Rome was not just an empire of soldiers, it was an empire of contracts. The Roman state outsourced almost everything: tax collection, mining, road construction, grain supply, military logistics. These contracts were handed to private corporations called publicani. Yes, corporations. They pooled capital, they issued shares, they promised profits. Ordinary Roman elites, senators' friends, merchants, landlords, could invest in them. No factories, no innovation. Just one bet: Rome will keep expanding. Sound familiar? At first, it worked beautifully. As Rome conquered new territories, more taxes flowed in, more slaves lowered costs, more land increased output. Publicani profits exploded. Investors didn't ask, "Is this sustainable?" They asked, "How much more can I put in?" Speculation had begun. Prices of shares rose, not because of productivity, but because everyone expected someone else to buy at a higher price. This wasn't capitalism yet. It was something older: narrative-driven investing. The story was simple. Rome is eternal. Rome always wins. Rome will never stop expanding. That belief became the asset. Now pause. Replace Rome with the US economy, the housing market, tech stocks, crypto, AI, index funds. Different language, same psychology. Then reality arrived. Wars slowed, expansion stalled, costs rose. Rome still needed money, desperately. So the state did what states always do in a crisis. It changed the rules. Contracts were renegotiated, payments were delayed. Political enemies targeted specific firms. Senators passed laws hurting publicani profits. And suddenly, those guaranteed returns weren't guaranteed at all. Confidence cracked. Here's the dangerous part of speculation. It doesn't collapse slowly. It collapses when belief breaks. One firm failed, then another. Then investors rushed to sell. But there were no buyers, because everyone had believed the same story. Rome's first market crash wasn't loud. No headlines, no ticker tapes, just quiet ruin. Elite investors lost fortunes, credit froze, tax collection collapsed, the state panicked. And Rome learned something terrifying. When markets fall, the real damage is political. So Rome responded the way modern governments do. They didn't save investors, they saved the system. Debts were restructured, losses were socialized, power concentrated upward. Small investors were wiped out, large insiders survived. The state tightened control. Sound familiar? Because this pattern repeats every time. Fast forward 2,000 years. Stock markets are digital now. But speculation hasn't evolved. We still don't price assets on value. We price them on belief. Belief that prices will go up, governments will step in, someone else will buy. Rome had legions. We have central banks, different tools, same function. Think about modern crashes. 2000, dot-com bubble. Companies with no profits, just stories. 2008, housing bubble. Assets priced on the assumption prices could never fall. 2020, liquidity panic. Markets didn't crash from fear, they crashed from leverage. 2021 to 2022, meme stocks and crypto. Narratives detached from reality. Each time, the pattern is identical. Speculation expands faster than reality. Debt amplifies belief. And when belief cracks, leverage turns gravity into a cliff. Rome didn't understand risk models, but they understood power. They knew markets are not neutral. They are political machines. Those closest to power. Exit first. Get information first. Get rescued first. Those farthest away. Enter late. Believe the narrative. Absorb the losses. That was true in ancient Rome. It's true now. Here's the uncomfortable truth. Stock market crashes are not failures of intelligence. They are features of speculative systems. You cannot remove crashes without removing speculation, and you cannot remove speculation without removing human hope. Rome didn't fall because of one crash, but each crash made the system more fragile, more centralized, more unequal. By the time the empire weakened, wealth was already trapped at the top. The middle investors were gone. The risk had been transferred downward. The state was addicted to debt and confidence. Again, sound familiar? Today, markets don't crash because people are stupid. They crash because leverage outruns reality. Narratives replace fundamentals. Systems reward risk-taking and punish caution. Rome taught us that first. So next time you hear, "This time is different," "This asset is safe," "This market always goes up," remember Rome. They believed their empire was eternal too. The lesson isn't, "Don't invest." The lesson is, understand the game you're inside. Because markets were never designed to protect you. They were designed to extract belief, convert it into capital, and redistribute risk downward when confidence breaks. Rome invented speculation. We perfected the technology. But the outcome hasn't changed. This is ancient finance, where history doesn't repeat, it compounds. If this changed how you see markets, subscribe. Because understanding money isn't about predicting the next crash. It's about recognizing that the system was never built to fall safely for everyone, only for a few.